Are you worried interest rates might increase even further? Are you worried about your disposable income? Do you want to position yourself to make the best in terms of which investment opportunities will deliver in 2024? In this week's episode, I'll give you a peek behind the curtains in terms of my prediction in terms of where interest rates and which investment markets will outperform. This is an episode you don't want to miss. Stay tuned. Hi, welcome to this week's episode of the Financial Dispensary with me, Dr. G. In this week's episode, I'm going to give you my personal predictions in terms of where I see interest rates heading in the year 2024 and heading and leaning into 2025 as well. If you have any questions or comments, feel free to drop them in the comment section, and remember to like and share this video if you found it insightful. So without further ado, let's get into some statistics and some numbers. So the first important part that I need to focus on is in terms of how the world is made up. Now, this is very important because a lot of the wealth and a lot of the power is still kind of concentrated in specific areas. So looking at this graphics, which gives us an indication of the global economy and GDP, you can see a vast amount of the wealth is still situated in the United States of America. Close on a quarter of all the wealth in the world and GDP is generated by the US. This mustard yellowish color being Asia, obviously leading the charge there is China. The green being Europe, also a big pocket. And you can see a lot of the wealth is still concentrated in those three core areas. So North America, driven by the US. Then you have Asia, driven by China. And also Europe, being the green channel. You can see right here at the far right is Africa, just making up a sliver. Unfortunately, South Africa dropping down now to third behind Nigeria and Egypt as the third biggest economy in Africa. And the reason why I show you this graphic is just to highlight again the importance of specifically the US in the global economy. Unfortunately, what happens in the US affects the rest of the world dramatically. There's that old saying that when the US sneezes, the rest of the world catches a cold, and this is very, very true as well. So for this week's episode, you're going to see I'm going to zoom in a lot in terms of what's happening currently in the US, because that's going to be a key indicator for us or predictor in terms of what will happen for the rest of 2024 and heading into 2025. So just quickly, in terms of a bit of a history lesson, that is the United States inflation rate. So obviously what happened is during the COVID pandemic that started in 2019 and kind of early 2020, remember most of the developed countries in the world went through a hard kind of lockdown and a restriction period. So effectively just closing up the entire economy. Fortunately, the rich countries like the US had money and debt that they were willing to take on. So to support the economy, they did two things. First, they cut interest rate down to effectively zero. And secondly, they effectively injected a lot of liquidity using different mechanisms into the economy. So just remember, you're sitting at home, you're getting money for free effectively. You can't go out and shop. So there was limited things for you to spend your money on. And what we saw is specific areas of the economy then had quite a run. The net effect, however, is that if you inject a lot of money into economy like they did, and people kind of just spend a lot of money, there is lots of money chasing fewer products and services. And the net effect is that you see this inflation rate jumping up. So you can see here from the year 2020 into 2021 and then definitely into 2022, the inflation rate in the United States hit almost 10%. It probably topped out around kind of 9-ish kind of percent, which is way above the threshold that they position themselves for the economy, which is only 2%. So I always explain to clients, think about it as a kind of a pendulum that swings because of the interest rates that were cut down to zero. We had this dramatic jump up in inflation, far above their kind of target level of 2%. And during 2022 and 2023, they had to start increasing interest rate to counter this pendulum that needs to swing now to the other side to bring inflation down to their target level of only 2%. So that's a kind of a longer term graph showing you in terms of what happened with inflation. So obviously a key indicator that we're keeping a very close eye on is when do we feel will this inflation rate drop down to 2% or below, which is their target. So this is a slightly longer term kind of number. Looking at it from a 1 year figure, you can see a year ago it was still 6%. Currently it's down to 3.4%, so we're definitely moving in the right direction, but 3% is still far above 2%. So the market needs to have clarity and kind of certainty that this number will come down to 2%. That will give us a very good indication in terms of where interest rates will go. Another metric that we're also keeping a close eye on is just the core CPE. So the core CPE is just, again, another fancy statistical number. It's actually one of the preferred kind of metrics that the US Reserve Bank, which is called the Federal Reserve, actually keeps an eye on. So again, you can see nicely this number during 22 topped out and is on its way down. But again, the $1 million question is, will this number come down to below kind of 2%? So the big kind of discussion that's currently banning about is that these statistics in terms of the inflation numbers, there's a long lag and a delay in terms of these numbers. So the data that's collated is not it's not very accurate or up to date. There's a long delay, kind of between 3 and 6 months of the data of the numbers that we see. So hence why some of these other metrics that we're kind of keeping an eye on is what we call kind of trueflation. I just wanted to show you that one. Where's the trueflation one? I'll show you that just now. Where the true inflation number is probably closer to about below 2%, actually 1.4%. If I actually just open up a tab and get trueflation for you quickly. So trueflation effectively is just a statistics that a guideline that we use to show in terms of what the actual inflation rate is at the moment using more up-to-date data. And you can see there the trueflation number being closer to about 1.4%. So 1.4% is obviously well below the 2% threshold. So all that this means, it bodes well that one metric being this more kind of trueflation or actual inflation is already below 2%. And looking at the more accurate kind of statistics, the numbers are definitely trending downwards, as we can see. Still not close to 2%, but definitely moving in the right direction, which is a very good positive. And all that means is that the likelihood of them increasing interest rates again is very, very slim. And the likelihood of an interest rate reduction is very high. The question is just in terms of when. So two other metrics that I just wanted to show you quickly. So the Federal Reserve has got two mandates. The one is price stability, which is driven by inflation. So the goal is they need to keep inflation below 2%. And as you can see, they're doing a kind of okay job, but they're still not there. Hence why it's unlikely that they'll cut interest rates now. The second key metric that they need is to have unemployment below 4%. And you can see that the unemployment, obviously it spiked there during the COVID pandemic. It's still below 4% and it's actually been fairly flat and stable at the moment. So if you look at the actual 1 year number, it's only at 3.4%. So from an employment point of view, there's no rush for the US economy to increase interest rates, to cut interest rates. So remember again, this is this inverse correlation between unemployment and interest rates. If you cut interest rates, you effectively support the economy by injecting liquidity into the economy. So if interest rates are cut, it will support the unemployment rate. So this is another statistic that we're keeping a close eye on, is that if we see this number spiking up dramatically, the likelihood of interest rate cut is more likely. But as you can see, it's fairly flat, unlikely that this number will move up. And the only other reason why the US economy might cut interest rates sooner is if they head into a recession. Now, again, looking at this GDP growth rate, these numbers are still far above zero. So again, the likelihood of the US economy going into recession is still very, very unlikely. Early last year, there was a lot of pundits predicting that the US economy will actually go into a recession in 2023 already. The economy is very robust and very strong, which means that this also on a probability kind of metric is fairly low. So my prediction is the US economy will most likely not head into a recession. Yes, these numbers will continue to head kind of downwards, but won't go negative. I can't see the unemployment rate spiking up dramatically. There's already been a lot of kind of layoffs, specifically in the tech space, but again, the economy is still fairly robust. The only thing that we are keeping a close eye on is this kind of inflation rate, maybe this kind of metric, is that when will this metric come down to 2%? And again, based on more accurate, up-to-date kind of numbers, the true inflation number is actually already below 2%. So all of this bodes very well that my prediction is interest rate won't increase again, and they'll more likely come down. So, okay, Dr. G, when will they start cutting then? That's the question. One metric that we follow is it's a prediction market called Kalshi. And here you can see where people kind of make a calculated guess in terms of when they feel interest rates will be cut. So late last year, the prediction was for earlier. So let's say even if you go March, that the rate that the US Federal Reserve will start cutting. You can see at the moment that rate is very slim at only 10%. That number has been moving forward now. So at the moment, the Fed rate cut by May, there's a 57%. You can see at the height during early kind of Jan-ish, this number was close to almost a 90%. But obviously, again, as we get more data, every time that Jerome Powell does a press conference, we get a better indication. And it seems that the market is predicting that the rates will start being cut in the second half of this year. So May, there is a likelihood, but it's still maybe a 50-50 call. But you see, if I now move from May to June, it jumps up to 85%. So May, 50-50, June, 85% at the moment. And what about July? July, 93%. So there you can see it. So what the market is looking at the moment, it's saying economy is strong, recession unlikely, employment is kind of okay-ish, inflation is coming down, and because of that slight delay in the statistics, the true inflation number is probably already below 2%, and that's all that they need. Inflation below unemployment below 4%, it's currently on 3.7, and inflation below 2%, true inflation says it's already at 1.4%. Hey, you know what, we can start cutting. And that's what we're seeing at the moment, is that most likely in the first part of the second half of 2024, the United States will start cutting interest rates, which will give the rest of the world the indication that you guys can also start cutting interest rates. So again, remember, because of the US economy being such a big player, us being a very small player, the South African economy in the global kind of world numbers, our Reserve Bank will very unlikely cut interest rates before the US. They'll most likely wait for the indication of the US economy to start cutting, and then we'll cut as well. So looking at the the dates. So as we said, we know that this date, the end of April, 1st of May, is probably a 50-50 call. It would be a bold guess to predict that they'll cut there. But this number of June, early to mid-June, 11 to 12 June, that the US will start cutting is a very good indication. So if I now link that to when we have our reserve meetings, so you can see our inflation number is at 5.1%. Remember the South African government's inflation target? Back in the day, it was a range between 3 and 6%. At the moment, the Reserve Bank actually said they want to go for the middle of that range, which is 4.5%. But our inflation is well under control. So in theory, and that's why a lot of people are quite saying that South African economy is struggling, why aren't they cutting interest rates? But it's because we are such an integrated economy with the rest of the world. We cannot afford to cut interest rates prior to the US. So you can see our prime at a whopping 11.75%. The US is currently between 5 5.5 and 5.75, so less than half of our rate. You can see our interest rate on historical terms is fairly high. Just looking at the calendar, so we've got a monetary policy on the 30th of May. So again, if I was a gambling man, I don't think we'll cut on that date. Remember, my prediction is that the US will cut during that 11 to 12 June meeting. So what we need to do is we need to look at when is our next meeting after that one. And that would be the 18th of July. You can see our Monetary Policy Committee meeting is on the 18th of July. And my prediction is, I predict that the South African Reserve Bank will start cutting interest rates from the 18th of July and then slowly into the rest of the second half of 2024 and then heading into 2025. My prediction is because of, again, just looking at I want to take a longer term. Let's see if I can't have such a long term track record. But because inflation has this kind of niggly effect that sometimes it can jump up in a short space of time quite dramatically. My second prediction is that the reserve banks will not cut interest rates dramatically. The only reason why they'll be motivated to cut interest rates dramatically if something breaks. So if the economy goes in a recession, which in my view is very unlikely. So what I'm also predicting is they'll cut slowly. So both in the US and both in South Africa, I predict that they'll start cutting interest rates at 0.25%, which is 0.25%. And my prediction is we'll cut 3 times during this year. So we'll cut during July. We'll cut again. When is that? The next one? I missed it. July. And then November again. Yeah, so maybe most likely kind of twice per year, twice 2.25%, maybe 3.25% during the 2024 year. What that would mean for your kind of budget, I just had a couple of numbers here. So let's say you had a vehicle that you were financing at 300,000 at the current kind of prime plus 2 rate. That would be 6,100 Rand that you're paying, 6,142. That number most likely will come down to the end of the year at 6,022. So it's about a saving of 150 Rand. And on the bonds, on a standard kind of 2 million property, you would currently pay 21,600. That number would most likely come down to 20,600. So a saving of 1,000 Rand. So in a nutshell, the interest rates will come down during 2024 and definitely even further into 2025 as we get more data out from the various economies. This will lead to a saving in your monthly budget. But remember, by far the best strategy for you is that even if the interest rates come down, that you do not reduce your monthly repayments. So to try and maintain the same Rand amount that you currently are paying on your debt. And the reason why that's just recommended and why that is a very good recommendation for you is that in that way, you'll actually pay down this debt quicker. So whether it's a bond, a vehicle, or credit card debts, or any other loans, try and maintain the current monthly repayments. You'll see that the payment term will reduce dramatically. So only try and reduce the monthly repayment if you're already not kind of if your budget or finances is not balancing out. In that way, you can reduce it slightly. But if at all possible, try and maintain the monthly repayment that you have on your loans. And as a closing kind of thought, knowing that interest rates are going to come down, this is a very big driver for what we call kind of risk assets. So risk assets being equities, property, and then specifically crypto as well. So as interest rates reduce, this is a very nice boost for most economies, or most kind of equity or growth kind of markets. So from in terms of an asset allocation point of view, if you currently have a lot of money in fixed deposit or cash or money in the bank, just know that during 2024 and definitely into 2025, that interest rate that you get on those kind of investments will start coming down. And at the same time, all of the growth assets, so equity, property, and crypto, will start increasing in value. So from a positional point of view, I think you've got 6 months probably time available to position yourself for this kind of next wave in terms of where we are in the economic cycle. And again, my prediction is that as interest rates come down, obviously the returns on your fixed deposit and interest rates will also start coming down. But at the same time, the returns that you can get in crypto equity, as an example, will start increasing. So now is a good time to position yourself. Obviously, if you have any other questions or comments, feel free to drop them in the comment section. Myself and my team are always on hand. As always, I'll drop all my socials and the details below to get in contact with myself or my team, and we'll gladly assist in terms of trying to add more value, giving sound quality, good advice in terms of how to position yourself. And there you have it. Thanks for sticking around till the end. My name is Dr. G. If you found the content valuable, please like and share this episode with friends and family. And until next week, goodbye.